Welcome back to the deep dive. This is part 3 of our 5-part look into that big question hanging over tech right now. Are we in an AI bubble?
We are. And today we're really zeroing in using, well, probably the best historical parallel we have, the dot-com bubble. You know, that whole period from roughly 95 to 2002.
Right, that roller coaster.
Exactly. And we're going to map that onto what's happening right now, 2023 to 2025, in AI investment. The main question we're tackling is 2025 basically AI's 1999 moment?
Okay, and just to set the stage, the dot-com thing wasn't just random speculation, was it? It felt like a perfect storm. Policy, money, psychology.
Oh, absolutely engineered.
Yeah.
You look at the macro picture back then, and the ground was incredibly fertile for taking big risks. You had the Fed cutting rates in '98 after some global crises.
Flooding the system with cash, easy money.
Yeah, easy money right when tech optimism was hitting its peak. And then you also had policy nudging things along. Remember the '97 Taxpayer Relief Act?
Lowering capital gains tax,
Ugh.
making it more attractive to gamble on stocks instead of playing it safe.
Precisely. So the financial fuel was definitely there. But the real engine, I think, was psychological. It was this really powerful belief in the new economy.
The idea that the internet changed everything, so the old rules just didn't apply.
Exactly that. And if you bought into that narrative, then traditional ways of valuing companies, like, whether they actually made money,
Suddenly seemed obsolete. Yeah.
obsolete, quaint, whatever you want to call it, and the proof is right there in the numbers. By 1999, the NASDAQ's price-to-earnings ratio, the PE ratio, it soared.
What was it? Something crazy.
An unprecedented 200.
200. Okay, let's break that down for a sec. A normal PE is maybe 15, 20.
Right. So 200 means the market was paying $200 for every single dollar a company earned in a year. It's pricing in maybe a century of perfect growth.
Pure belief, not fundamentals. Which loops back to that psychological driver you mentioned, FOMO. Fear of missing out.
Totally. When everyone around you seems to be getting rich overnight on internet stocks, speculation starts feeling less like a choice and more like something you have to do.
Right, or you'll miss the revolution.
And that feeling drove the money flow. Which brings us to the accelerators, venture capital, and the whole IPO mania.
The VC numbers from back then are just wild. In '99, what was it, like almost 40% of all U.S. venture capital?
39%, yeah.
Yeah.
Nearly 40 cents of every VC dollar went into internet companies. And that cash allowed these startups, sometimes with barely a business plan,
Just an idea and a .com name.
pretty much, allowed them to just burn through cash like there was no tomorrow. The mantra was, get big fast.
Dominate the market now, figure out profits later, and the IPO market just poured gasoline on that fire.
Oh, absolutely. 1999 saw a record 457 IPOs. Think about that. More than one company going public every single day.
And the crazy part was the first day pop, right?
Yeah.
Stocks doubling or tripling on day one.
Often, yeah. It created this feedback loop. If you could get IPO shares, you made instant money, which just encouraged more IPOs, more speculation. Fundamentals didn't even enter the picture.
And we can't ignore the role of the banks and analysts in all this.
No. Huge conflicts of interest there. Investment banks made fortunes underwriting these often shaky IPOs. And then you had their analysts. Remember Henry Blodgett at Merrill Lynch?
Telling people to buy Pets.com even as it was failing. The same Pets.com his bank had just taken public.
Exactly. The incentive was to keep the hype machine going, keep the trading volume up, support those banking fees. It's not a great look in hindsight.
So, okay, profits are quaint. What were they measuring then? How did they justify these insane valuations?
They invented new metrics. Proxy metrics, really. Things that measured potential, not actual performance. You heard terms like eyeballs.
How many people visited the website?
Right. Or page views, clicks. The logic, however flawed, was grab the audience now, build a monopoly, and then figure out monetization.
Which meant spending like crazy on marketing to get those eyeballs. Pets.com is the poster child, isn't it? The sock puppet, the Super Bowl ad.
The Macy's parade balloon.
Yeah.
All funded by VC money, even though the core business was losing money on every single sale.
That's the key point, right? Negative gross margins.
Yes. Let's linger on that because it's crucial. It means the cost of the goods, like the pet food, plus the cost of shipping it, which was super expensive back then, was more than what they charged the customer.
So every box they shipped, they lost money. They were literally paying people to take the product.
Funded by VC cash. It's a fundamentally broken model built purely on the hope of future scale and somehow, magically, future profits. It couldn't last.
So the crash felt inevitable, but were there people warning about this? Any voices of caution?
There were. Alan Greenspan's irrational exuberance comment in '96 is the famous one.
But the market just shrugged that off and kept climbing for years.
It did. But closer to the peak, you had some sharper warnings. Barron's ran a cover story in March 2000 called Burning Up.
Ooh, ominous.
Yeah, it detailed the unsustainable cash burn rates at many dot-coms. That really sent a chill through the market. And then you had smart investors taking action.
Like Sir John Templeton.
The legendary Sir John Templeton. He didn't just talk, he put his money where his mouth was. He started shorting dot-com stocks in early 2000.
Betting against them. Why then specifically?
He timed it brilliantly. He anticipated the end of the IPO lockup periods.
Ah, the period after an IPO where insiders, the founders, and early investors can't sell their shares, usually 6 months.
Exactly. Templeton figured that once those lockups expired, insiders would rush to cash in their hugely overvalued stock, flooding the market and causing prices to collapse. And he was right.
Disciplined, contrarian thinking. So the crash happens. It must have been brutal, sorting the survivors from the casualties.
It was the Great Reckoning. Look at Pets.com blew through its entire $82.5 million IPO funding in just 9 months. Because, again, that broken business model.
And Webvan, the online grocer.
On another huge flameout, they spent something like $800 million building giant automated warehouses in multiple cities before they'd even proven they could make money delivering groceries in one city.
They scaled the cost before they validated the business. Classic mistake.
Textbook. So those are the failures. Bad unit economics, scaling way too fast. But the survivors, that's where the really valuable lessons are for today's AI scene.
Okay, like Amazon. How did they make it through?
Amazon was always focused on the long game, building out logistics, fulfillment centers. But critically, they had financial discipline. Just before the crash, they secured a huge $672 million bond offering.
Getting cash on hand right before the capital markets froze solid, smart.
Life-saving, probably. That cushion let them survive when others couldn't raise a dime. And then there's Google. They stayed private longer, until 2004.
And they had more than just good tech.
Much more. They had superior search, yes, but crucially, they developed a scalable revenue model. Keyword advertising. They had a clear path to making serious money, which many dot-coms just never figured out.
So survival came down to either a viable business model or a big enough war chest.
Pretty much. Financial discipline was key. But here's the really fascinating twist, the irony of the whole bust.
The infrastructure.
Yes. The infrastructure it inadvertently funded. Trillions in paper wealth vanished, sure, but all that invested capital wasn't totally wasted.
You mean the dark fiber thing?
Exactly that. Telecom companies went absolutely nuts, spending over $100 billion laying fiber optic cables everywhere. Companies like WorldCom.
Who then went spectacularly bankrupt.
Right. So the companies that paid for the fiber went bust, but the physical glass fiber, still in the ground. Suddenly, there was this massive oversupply of bandwidth capacity.
Which made bandwidth dirt cheap.
Dirt cheap. And that dramatically lowered costs for the next generation of internet companies, the ones that needed lots of bandwidth. Think YouTube, Netflix, Facebook, the whole Web 2.0 wave.
So the dot-com bubble essentially subsidized the rise of Web 2.0.
In a very real way, yes. Same with data centers. Huge server farms built during the boom got repurposed later, helping kickstart cloud computing. The bubble bust cleared the decks, but left behind the foundational infrastructure.
That's a powerful lesson. Okay, let's pivot hard now, bring that lens to today. Is 2025 AI's 1999? What echoes are you seeing?
Oh, echoes are loud. First, valuation vertigo. It's back, maybe even more extreme. We're seeing AI startups with, say, $5 million in annual recurring revenue.
ARR, yeah. Pretty modest.
Right. And they're seeking valuations north of $500 million. That's a 100x revenue multiple.
100 times revenue. Again, pricing in decades of perfect execution. That feels very familiar. And the cash burn.
Deeply familiar. Look at the AI leaders like OpenAI. Hugely influential, but currently unprofitable. They justify massive losses as necessary investment.
Necessary for what? Training these huge models and hiring the talent.
Exactly. Training large language models costs a fortune in computing power, and the competition for top AI researchers is incredibly fierce, incredibly expensive. The strategy is the same. Capture the market, achieve dominance now, figure out profits later.
It's get big fast all over again, just with algorithms instead of eyeballs. But the scale of investment seems way bigger this time.
Orders of magnitude bigger. VCs put over $160 billion into AI globally in 2023 alone. Remember, the peak year for dot-com VC was around $10.5 billion total for internet startups.
Whoa, $160 billion versus $10 billion dollars? That's a lot
So
more fuel.
it is. Which brings us back to that infrastructure point. If $100 billion on fiber optics helped inflate the dot-com bubble, what about the spending on AI infrastructure today?
The huge GPU clusters, the AI supercomputers.
Yeah, estimates suggest big tech companies are planning to spend somewhere between $300 billion and $400 billion collectively on AI infrastructure build-out.
Okay, 300, 400 billion. That sounds astronomical compared to the $100 billion dollars on fiber. Is it proportionally crazier, though, considering inflation and how much bigger the economy is?
That's a fair question. It's massive, but maybe not as outlandishly speculative relative to GDP as the fiber build-out was. However, look at the metrics used to justify it.
The new eyeballs, what are they now? Model
Right.
prowess?
Things like that. Or token efficiency, parameter counts, user engagement metrics, things that sound impressive but are often really hard to directly connect to generating actual revenue down the line. It rhymes with the dot-com metrics.
Same pattern.
Yeah.
Focus on potential. Delay the hard questions about profit. So this huge spend on foundation models and compute, is that the modern equivalent of the fiber network?
I think it absolutely is. It's the core infrastructure play for the AI era. And it raises that critical question. Are we potentially building AI's dark fiber?
Meaning, are we creating way more foundation model capacity or specialized AI compute than the market can actually use productively right now? Building supply way ahead of real demand.
That's the risk. Are models becoming obsolete faster than applications can be built on top of them? It's a real possibility.
Yeah.
But there's a crucial difference this time compared to 2000.
Which is?
Who's building the infrastructure? Back then, a lot of that fiber was laid by relatively shaky, debt-heavy startups like WorldCom that went bust.
Right. But today, this $300, $400 billion AI build-out.
It's largely being driven by the tech giants. Google, Microsoft, Amazon, Meta.
Yeah.
Companies with incredibly deep pockets and existing profitable businesses.
So even if there's a shakeout or a crash in AI valuations, these underlying infrastructure builders are much less likely to collapse entirely.
Exactly. The infrastructure itself might be more resilient. We might still see a correction, maybe even a crash in the startup space. But the foundational compute layer, largely controlled by big tech, will likely persist.
That's fascinating, because it suggests that while the risk profile of the infrastructure is lower, the outcome might be different, more concentrated.
Potentially, yes. If the core AI infrastructure remains controlled by a handful of giants after any shakeout, the golden age of AI that follows might look much more oligopolistic than the relatively decentralized Web 2.0 era that emerged from the dot-com ashes.
Fewer winners, maybe? Bigger moats?
That's certainly a possibility, which kind of brings us full circle to our main thesis. Is 2025 AI's 1999?
Yeah.
All this evidence? It strongly suggests yes, we are likely in that period of speculative fever.
But following the thinking of economists like Carlota Perez, maybe that's not entirely a bad thing. Bubbles can be destructive, but they also serve a purpose.
That's the argument. These manias, however messy, are incredibly effective at mobilizing vast amounts of capital and talent very quickly around a potentially world-changing technology. They force the build-out.
So a crash might clear away the froth, the unsustainable business models, but the underlying technological shift, driven by the infrastructure built during the boom, is still likely to happen by, say, 2030.
That's the historical pattern, and it seems likely to repeat. The installation phase, funded by speculation, gives way to the deployment phase, or golden age.
Okay, so if we accept that context bubble now, transformation later, what's the practical takeaway? What's the playbook for you listening right now, trying to navigate this?
3 key things, I think, drawing directly from the dot-com lessons. First, scrutinize the unit economics.
The pets.com lesson. Don't fall for vision alone if the basic business math doesn't work. Demand a clear path to making money on each transaction or customer.
Absolutely. Second, interrogate the proxy metrics. Be really skeptical of today's eyeballs, things like model performance benchmarks or user counts, unless there's a very clear, credible link to how they will generate actual revenue.
Don't get seduced by vanity metrics. Got it. And third,
value financial discipline. Cash is king, especially when markets turn.
Yeah.
Favor companies that manage their money prudently, that have a solid cash cushion.
the Amazon lesson. Survival itself becomes a competitive advantage when capital dries up, because it will dry up again at some point.
History suggests it always does. So yeah, the AI boom is real. It's funding something revolutionary. but it's likely doing it through the messy, volatile process of a speculative bubble.
Which leaves us with maybe one final really important thought to chew on.
Right. Given that difference, we noted the concentration of this massive AI infrastructure build-out within today's big tech companies.
Unlike the scattered failures of the telecom build-out.
Exactly. We have to ask, if the golden age of AI is built on this foundation, will it be fundamentally more centralized? Will the power, the opportunities be concentrated in fewer hands than the Web 2.0 era was?
Who controls AI's version of dark fiber? And what does that mean for innovation, for competition down the road? That feels like a critical question for the next decade.
It really does, something we all need to keep thinking about. Well, thanks for diving deep with us today on this AI bubble question, the key takeaway.
Temper the excitement, look at the historical parallels. These speculative cycles seem to be part of the process, a feature, not a bug, of major tech shifts.
Hopefully these insights give you a better framework for navigating what's ahead. It's going to be a volatile ride, but likely transformative in the end.
Absolutely. Before you head off, please do subscribe if you haven't already so you don't miss the next parts of this series and our other deep dives. And hey, if you want more practical tutorials and hands-on insights into AI tools and tech,
Definitely check out the YouTube channel, Ian Ochieng AI. That's IANOCHIENG. Ooh, Jane AI. Lots of great stuff there.
we'll put a link in the description too. Thanks again for listening.
Until next time, keep digging.
See you soon.